In this video, we're going to discuss the federal income tax system. So as an American citizen, almost everyone is subject to income tax at some point in their lives. If you have low enough income, typically you don't have to pay income tax, but most people will eventually make enough income to have to pay the income tax. So we're going to talk about how you calculate your income taxes. Keep in mind, even if you pay a service to do your income taxes, it's still important to understand what's going on behind the scenes so that you can make sure you protect yourself. Knowing whether or not numbers make sense, for instance, is going to be important. You shouldn't just ultimately rely on someone to calculate your taxes for you. You should at least be able to understand what you're looking at to make sure that no one's taking advantage of you and to make sure that your taxes are being done correctly. So income tax is a percentage of your income that's collected by the government to fund its services and programs. Income taxes are automatically deducted from your paycheck by your employer, and the amount's based on how you fill out a W-4 form at the beginning of your employment. So on your W-4, you'll list how many exemptions you plan to take. You'll list whether or not you have another person in your household that makes income. All of those different things go into the determination by your employer of how much income tax is going to be withheld from your paycheck from month to month or from pay period to pay period. So first thing we need to talk about is taxable income. So one thing to keep in mind is at the end of the year, the government doesn't actually tax all of your income. They only tax the portion of your income that they consider to be taxable. In other words, they start with all of the income you make, which we're going to call gross income, and then they gradually deduct values from that, and what results is what we call taxable income, and that's going to be the portion of your income that they actually apply the tax rates to. So again, we start with what we call gross income. That's just all your income. Imagine just putting it all together into a big pot. So what could this come from? Well, this could come from wages that you're actually paid by your employer. If you make tips, tips are considered part of your income. You do have to declare tips for tax purposes. And then also if you have investments, any interest or dividends that you make during the year are also considered taxable, so you have to report that income during the year. Once all of your gross income is put together, the next step is calculating your adjusted gross income, which is going to take your gross income and it's going to subtract certain allowable amounts that we call adjustments. Now, not everyone is subject to adjustments. Adjustments are specific amounts that are subtracted. There will be certain amounts that are subtracted in the taxable income calculation process that apply to everyone. Adjustments are very specific and they only apply to specific people in specific situations. So for instance, certain retirement accounts, if you contribute money during the year to your specific kind of retirement account, that particular amount can potentially be subtracted from your gross income for tax purposes. Also, tax-deferred savings programs, you can subtract that particular amount that you've contributed. Interest paid on many student loans, which is really great for students. In a lot of situations, the interest you pay on your student loan can be subtracted for tax purposes. And then also alimony and child support payments. Why does the government allow you to subtract these amounts? Well, some tax policies are set to encourage certain behavior. So if the government considers it important that you contribute to a retirement account or that you make your alimony and child support payments, this is intended to be a benefit that encourages you to actually adhere to those types of things and make sure you actually follow through with those types of things. So first formula, our adjusted gross income formula. That's going to be your gross income, which again is going to be all of your income for the year thrown into one pot, put together, minus any adjustments that apply to you. And again, adjustments are very specific amounts. Not everyone is going to be subject to adjustments, whereas the next types of deductions we're going to talk about, people will all be subject to. So once we take our gross income, subtract those adjustments, we arrive at what we call adjustable gross income, which we abbreviate as AGI. Okay, the next set of values that are subtracted are called exemptions and deductions. Everyone is subject to exemptions and everyone is subject to deductions. So everyone gets to subtract these amounts to arrive at what we call taxable income. So we're going to start with AGI, and keep in mind, if you don't have any adjustments, your gross income and your AGI are going to be the same. If none of these subtracted amounts apply to you, then you're not actually subtracting anything from your gross income. So your adjusted gross income and your actual gross income would be the same. So we're going to take AGI and we're going to subtract these two amounts that we call exemptions and deductions. So an exemption is a fixed amount on your tax return that represents each person supported by your income. You can claim an exemption for yourself and for each dependent. So it's going to be an amount set by the government. For each person in your household that's supported by your income, you get to subtract this amount one time for each of those people. And that's going to then be, of course, subtracted off of your gross income, your adjusted gross income. It's going to decrease how much of your income is taxed. Okay. The other type of subtracted amount is called a deduction. So everyone gets to subtract an exemption, at least one, the personal exemption, and then everyone gets to subtract some form of a deduction. So a deduction is going to be a lump sum that you get to subtract. You may be able to subtract multiple exemptions. You only get to subtract one lump sum deduction. So there's going to be two options. The first option is you take the standard deduction. That's actually set by the government. So it's a set amount that you can subtract based on what we call your filing status. So are you filing taxes as a single person? Are you filing taxes as a married person? Based on how you file your taxes, this amount is predetermined for you. So that's going to be one option for every taxpayer. Now, the alternative to the standard deduction is what we call itemized deductions. So there are specific amounts, just like there are specific adjustments. If you have these particular amounts available to subtract, you can subtract them, but you're subtracting them as an alternative to the standard deduction. So you have two options when it comes to deductions. Either you're going to take the standard deduction or you're going to take the itemized deduction. How do you know which one you're going to take? Well, you're going to subtract whichever one ends up being higher. So either the standard deduction is one amount, or all of your itemized deductions as one lump sum amount. So what represents potentially a deduction that you can itemize and that you can subtract as an alternative to the standard deduction? Well, home mortgage interest that you pay during the year is considered an itemizable deduction. State income taxes can be deducted. Local income taxes are the same as well. So taxes that you would pay to another taxing authority other than the federal government can be deducted from your taxes at the end of the year. Property taxes, again, that factors into local taxes. Charitable contributions, as long as the charity is recognized by the federal government. And then also medical expenses, although there are some requirements based on the medical expenses. They have to exceed 7.5% of your adjusted gross income. So just, for instance, insurance premiums for the year won't necessarily count unless everything adds up to more than 7.5% of your adjusted gross income. So again, common misconception here when you're getting towards your actual calculations. You don't get to deduct all of these amounts. You either take the standard deduction as a single amount, or you take all of your itemized deductions. Think of that as one big lump sum. You take all of those and subtract all of those as one unit. Now, in a lot of situations, you will be almost obligated to take the standard deduction because you don't have enough itemized deductions. Most people will not have enough deductions to itemize until they buy a house. Usually what pushes you over the edge is going to be your home mortgage interest and then your property taxes. Particularly here in Texas, because we don't have a state income tax, our property taxes tend to be higher. So in a lot of cases, you pay enough property taxes to then allow your itemized deductions to come out to an amount where they surpass the standard deduction. But again, keep in mind, it's either going to be the standard deduction or it's going to be the itemized deductions, but it's not going to be both. So once we determine all of our exemptions, once we determine what deduction is going to apply to us, we can calculate our taxable income. So taxable income is going to start with adjusted gross income, and then we're going to subtract our deductions, whatever we choose, either the standard deduction or the itemized deductions. And then we're also going to subtract our exemptions. So again, remember, the exemption represents people supported by your income. So you can take one exemption for yourself, and then any people who are dependent on your income. So for instance, if you have children, children are typically considered to be dependents. If you take care of an older parent, something like that, that person may also be considered a dependent. You can take an exemption, one for each of those individuals supported by your income. So once all of those amounts are then taken into account, we have what we call taxable income. So that's going to be the portion of your income that the government is going to actually tax. The other amounts that have already been subtracted, for all intents and purposes, the government doesn't see them and it's not actually taxed. Those amounts are not taxed. So let's do an example where we calculate these different components and we ultimately arrive at taxable income. Okay. So a woman earned wages of $150,000, received $1,000 in interest from a savings account, and contributed $7,500 to a tax-deferred retirement program. She is entitled to a personal exemption of $4,050 and the same exemption for each of her 2 children. She's also entitled to a standard deduction of $12,600. The interest on her home mortgage was $25,000. She contributed $15,000 to charity, and she paid $12,000 in state taxes. Okay, so you'll notice I've gone through and I've highlighted all of the dollar amounts. That's a good place to start. So highlight them, circle them, do something to them. We have to make sure that every single one of these monetary amounts is taken into account in order to arrive at our amount for taxable income. So first thing we want to start is gross income. Gross income is just all the sources of money that we are making during the year. So you have to read through the problem and you have to identify things that are considered to be a source of income for the taxpayer. In other words, money that they're actually bringing in. Well, this person has wages of $150,000, so that's going to be a source of income. That's going to be part of gross income. She also received $1,000 in interest from a savings account. So again, that's money being paid to her. That's not interest she's paying. That's money that she's being paid for this savings account. That's interest that she's earning. So this is also going to be a source of income for the year. These are going to be the 2 sources of income. Everything else is then going to be a subtracted amount. So our gross income is going to be the sum of those 2 values. 150,000 plus 1,000 is going to give us a total of 151,000. So that's this person's gross income for the year. Now, once we have gross income, the next thing we want is adjusted gross income. In other words, from this amount, we want to determine if there are any amounts that represent adjustments that would then be subtracted at this particular point in the process. So notice this person contributed $7,500 to a tax-deferred retirement plan. This is not income. This is not money that she's making. This is money that she's putting into this specialized account that, from the government's point of view, is then an adjustable amount. So this $7,500 can be subtracted from her gross income to arrive at adjusted gross income. All of the other amounts either relate to exemptions or to deductions. So this is going to be the only adjusted amount. So we're going to start with the gross income of $151,000, and then we're going to subtract that adjustment of $7,500, which takes us to $143,500. That's going to be this person's adjusted gross income. So you might be wondering, if we're just going to subtract all these numbers, well, why do we have to break it up into 2 steps? Why not just subtract all the numbers at one step and get your taxable income? Well, the reason we have to subtract them in different layers is because there are certain other income tax-based calculations based specifically on adjusted gross income. In other words, things that are calculated just based on this amount rather than being based on the amount represented after we look at all the exemptions and all the deductions. For instance, that threshold for medical expenses is based on this amount. So arriving at this subtotal is going to allow us to make some other decisions about other components of your income tax filing. Now, a lot of those are going to be special cases that don't apply to a lot of people. So those are going to be situations, if you're not sure if you qualify something, where you want to consult someone who's a tax professional and who can give you better advice on something like that. But that's going to be why we break all these deductions down into pieces. Just the fact that certain amounts apply to adjusted gross income and then certain things apply to taxable income. So this is going to be our adjusted gross income. So we've taken care of our sources of income, we've taken care of our adjustment. Everything else is either an exemption or a deduction. Now exemptions are going to apply regardless. So you get to take one exemption as the personal exemption. You support yourself with your income, so you get to subtract an amount representing yourself. And then any dependent on your return, also you get to subtract an exemption for each of those people. Okay, so in this case, this person gets the personal exemption of $40.50. And then she has 2 children, so she has 2 dependents. So for each of those 2 children, she's also going to subtract $40.50. So that means in total, this person gets to take 3 exemptions, 1 for herself, and then 1 for each of her 2 children. So that means the value $40.50 is going to be subtracted 3 times to arrive at taxable income. Now the hardest part is figuring out what to do with deductions. So we've been told that the standard deduction is $12,600. So again, that's going to be the number set by the government. You always have the option to take this as a deduction. It's a predetermined amount, and regardless of any other situation, you can take this particular value and subtract it from your income. Now the alternative, remember it's an alternative, we don't choose both, but the alternative to subtracting this amount is taking the total of your itemized deductions and subtracting those instead, subtracting those as an alternative. So this person has home mortgage interest of $25,000, charitable contributions of $15,000, and $12,000 in state taxes. So each of those 3 amounts would be considered an itemized deduction. So we can either take $12,600 and subtract that amount, or we can take the total of the itemized deductions and subtract those amounts. So how do we know what we want to do in any particular situation? Well, we need to compare the actual amounts. So we want to compare how much is the standard deduction worth, how much are the itemized deductions worth. So the standard deduction is worth $12,600. The itemized deduction is going to take the sum of all of the individual components. So that's going to be $25,000, $15,000, and $12,000. And all of that is going to sum up to $52,000. So we're comparing those 2 values. Clearly in this situation, the itemized deductions add up to more. Now suppose the itemized deductions had maybe added up to $5,000, something like that. In that case, this person would want to take the standard deduction instead. So you're either going to subtract this amount, this total, or you're going to subtract this amount, the standard deduction. You're going to choose whichever one is higher, but you do not subtract both. That's probably going to be one of the easiest mistakes to make when you do this kind of calculation. You cannot subtract both. It's going to be whichever one is higher in the particular situation for the particular taxpayer. So we know everything we need to know. So let's recap. We have the adjusted gross income. We have the exemption amount, and we get to subtract that 3 times, 1 time for the personal exemption, and then 1 time for each of the 2 dependents. And then we've determined that we're going to take the itemized deduction because that's worth more for this particular taxpayer. So starting with adjusted gross income, we're going to subtract the total itemized deductions of $52,000, and then we're going to subtract the exemption amount 3 times because this person has 3 exemptions. Once we do that, we're going to arrive at a value of $79,350. That is going to be this person's taxable income. In other words, for purposes of actually calculating how much tax this taxpayer owes, this is going to be the only portion of the income that the government is actually going to tax. So even though this person had a total of $151,000 worth of income during the year, this will be the only portion of that income that is actually subject to the tax rates that this person actually has to pay taxes on. And so that's why we call it taxable income. So I strongly recommend take a minute, pause the video, see if you can go back through this example on your own. Make sure you can categorize all the different values. Make sure you actually do all the calculations in your calculator, and make sure you come out with the same amount at the very end. Ultimately, this is going to be very much an exercise in using the calculator. Where are some common pitfalls using a calculator here? Well, notice you're adding together pretty large numbers. It's very easy to maybe add on an extra zero or maybe forget a zero. If you add on an extra zero or forget a zero, it will drastically change your answer. So those are going to be easy mistakes to make. What you want to do at every step when you're typing into your calculator is you want to verify that you are in fact typing what you intended to type. Go through and double check all the numbers you type before you hit enter each time and actually get an answer. Just look for those kinds of things and make sure you're careful and you pay attention to detail. Okay. So let's add on to the process now. So this is not how much this person owes. I want to clarify that. The person does not owe this much to the government. This is income, and this is the income that will be taxed. But we don't actually know yet how much the tax bill is going to be. We don't know how much tax this person is going to owe to the government. All we know is that this is the only portion of the income that actually is being taxed. So now let's talk about actually calculating the tax bill. How much is a person going to owe? So we use what we call a tax table, and we base the actual tax calculations on whatever taxable income is. So we use this table based on the amount we just calculated for taxable income. Now there is one additional amount that we may be able to subtract. You may not have to pay the entire tax bill if you have what's called a tax credit. So a tax credit is going to be the very last amount that can be subtracted. Once you calculate how much is owed in taxes, a tax credit can then reduce that amount. So it would be subtracted at the very end after we use the tax table and after we calculate the actual income tax owed. So we may know how much the bill is. We calculate how much the bill is. Do we actually have to then just write a check for that? Well, typically the answer is no. During the year, most people are going to pay part or all of their tax bill based on withholdings. So based on how you fill out that W-4 form at the beginning of your employment, if you fill it out very accurately, then in theory, your employer is already withholding and submitting to the government all of the taxes you're going to owe during the year. So as they withhold tax, they're then submitting it to the appropriate tax authorities, and they're paying your tax bill for you in a sense. So if everything is calculated correctly, your withholdings may actually take care of everything. If they don't, though, you're in one of two situations. So either you've paid too much, so maybe they withheld too much and it actually exceeds the amount of tax that the government says you owe. If you end up having too much withheld, then the excess is returned to you as a refund. So the government will either write you a check or they'll direct deposit the refund into your bank account that you list on your tax return. Now, if instead too little is withheld, in other words, maybe you didn't fill out your W-4 form correctly, maybe for some reason your employer didn't withhold everything, you may owe a little bit more. That is then sent to the IRS. So you have to write a check or you have to make some type of payment to the IRS for whatever is left over that you have not paid during the year via all of your withholdings. So ideally, the best situation is you don't owe anything and you don't get anything back. In other words, the exact amount that was supposed to be withheld is withheld. And so once you file your return, all you're doing it is essentially for information purposes. You're just recording all of your income for the year so that the IRS has a record for it, but you don't actually owe anything to them and they don't actually owe anything to you. So how do you make that determination? How do you actually know how much you owe so that you can decide, are you in the black, are you in the red, or are you in the clear and you don't need to do anything? Well, first thing you need to do, you're going to start with your AGI. So again, some taxable amounts are based on your AGI rather than your taxable income. So you're going to start with that as a subtotal. Now from that, you're going to build on it with your deductions and exemptions, and you're going to calculate your taxable income. So again, that's going to be the amount that we're actually taxing. That's the portion of your income that the government is considered taxable. And then from that, you're going to determine your income tax, which is going to be based on a tax table. There are going to be multiple tax rates that apply. Different rates apply to different portions of your taxable income. And so we'll look at the table in just a second and we'll talk about how you use that. So your actual income tax owed is going to be based on your tax computation from the table. And if you have any credits, at the very end, you're going to subtract your tax credits if you have any. Again, those are kind of like adjustments in the sense that not everyone has them. They won't apply to everyone. They're very specific in terms of the situations where they apply. So not everyone is going to have a credit at the end. If you don't have any credits at the end, then once you calculate your taxes using the table, that is your tax bill. And again, either all of that was withheld for you, maybe too much was withheld, more than this amount, or maybe too little was withheld. Regardless of the situation, that's where you make that determination. Now, what does this computation look like? Because that's going to be the most complex part of the process. It relies on a couple different things. So first thing we have to take into account is your filing status. Are you a single person? If you're single, you file single. If you're married, then you have a couple of options. Either you can file combined income with your spouse. We call that filing jointly. In other words, you take all your income, you dump it all into a pot, and you file one big tax return together with all of your income together. There are benefits to doing that because the government allows you additional sort of leeway. People who file married end up having to pay less tax for specific amounts of income than, for instance, people who file single. So there are benefits to filing jointly with whoever you're married to. Now, in some situations, it may be beneficial from a tax standpoint not to file together. So it's possible to be married but still file separate tax returns. You do your taxes, they do their taxes, and your income is considered separate for tax purposes. The other option is going to be head of household. So a head of household is unmarried, but they're required to support others to a certain extent that allows them then a benefit. So otherwise they would fall under the category of being single. Because they then support other people to a certain extent, the government gives them a little bit of benefit from a tax standpoint. So based on your filing status, either single, married filing separately, married filing jointly, or head of household, you then apply what we call marginal tax rates. So marginal just means part. Think of it as a part. We're applying tax rates to a part of your income. So this particular tax table is not completely up to date. Keep in mind, tax rules change a little bit every year, and the tax rates will change potentially from year to year. So your particular filing for one particular year is just based on the rates for that year. We're going to talk about the process. So the process is going to be the same no matter what, but just keep in mind these rates are not necessarily up to date. So these were up to date as of 2016. These were the rates, and this was the breakdown for how you use these rates. So based on your taxable income and your filing status, you're going to determine what layer you fall into. In other words, look at the highest amount, look at the taxable income, and then what range of values does it fall into. So for instance, for the single category, up to $9,275 is taxed at 10%. So that portion of taxable income is taxed at 10%. Now, what if you make more than $9,275? Well, that means that additional tax rates are going to apply. So all of your income from $9,276, in other words, the next dollar you made, all the way up to $37,650, that particular range of income, that is then taxed at 15%. We'll say you make more than $37,650. Well, the next layer of income takes you up to $91,150. That's then going to be taxed at 25%. So the more income you make, the more tax, of course, you have to pay. And the more income you make, the higher the rate is that ultimately applies to you. The highest rate that applies to you is called your tax bracket. So when you talk about a person fitting into a particular tax bracket, the tax bracket represents the highest tax rate that's applied to them. But there is a little bit of misunderstanding in a lot of cases about what a tax bracket means. So say, for instance, you're single and you make $100,000 worth of taxable income, not gross income, but taxable income. Well, $100,000 falls into the range from $91,151 to $190,150. So that means if you have $100,000 in taxable income, you would fall into the 28% tax bracket. Now, here's what that does not mean. That does not mean that all of your income is taxed at a 28% tax rate. That's not what it means. What it means is that's the highest tax rate that applies to you. So what we're going to do as we calculate taxes is we're going to actually layer your income. So if you had $100,000 in taxable income, which would take you all the way up to the 28% rate, you're then going to layer your income based on the lower rates as well. So the first $9,275 you make, regardless of how much you make in total, the first $9,275 you make is only taxed at 10%. So you only apply that rate to that portion of income. Now, if you make more than that, the next $9,276 up to $37,650 is then going to be taxed at 15%. Not the amount that was already taxed, but the next layer of income within that next range of income values. Now, once you make more than $37,650, so $37,651 up to $91,150, that layer, that particular chunk of your income is then taxed at 25%. And then again, if we're talking about ending at 100,000 is in the 28% range. So all of the additional income that wasn't taxed up to the $100,000 that you made that was taxed would then be taxed at the 28% rate. So when you say you're in a particular bracket, it does not mean that all of your income is taxed at that rate. It just means that's the highest particular rate that's going to be applied. But all of the lower layers, all of the smaller segments of your income are going to be taxed at those lower rates, just like everyone else's is taxed at those lower rates. So we're going to put some actual numbers in. We're going to actually do the calculation. We're going to use this table. So I printed it out on another sheet of paper so we can reference that as we actually look at the calculation. Okay, so let's look at the taxpayer we just did the taxable income for. So let's review that. So this person's taxable income came out to $79,350. So we're basing the tax computation off of that value. Okay, now the taxpayer is married, and this person is filing jointly with her spouse, who also contributes $60,000 to their combined taxable income. Okay, so for tax purposes, what that immediately tells us is that we're married filing jointly. We're using that particular filing status, so we're going to reference the values in that particular column. Notice all the rates are going to be the same. The rates are the same regardless of your filing status, but they apply to different segments of your income depending on how you file. So for single people, only up to $9,275 is taxed at 10%. For people who are married filing jointly, they can take more income taxed at that rate. So that's a benefit. That's actually beneficial. It means more income is taxed at a lower rate, whereas the single people have to pay more tax for lower portions of their income. So it is a benefit to be under the married filing jointly status. Now we need to determine these people's tax bracket. So it's not just the woman's income. Her spouse also contributes $60,000 of income. So we're going to sum all of their taxable income, and that takes us to $139,350. So that's going to be the total amount of taxable income for the purposes of this computation. So what we next need to determine is what bracket are these taxpayers in. So we know they're married filing jointly. We want to look at the table and we want to determine which range of values does this amount of taxable income fall into. So it looks like that falls between $75,301 and $151,900, which means if you travel across the table, that means that we have a tax bracket of 25%. Now, from a practical standpoint, what that also means is we're going to have a calculation with the 10% rate, we're going to have a calculation with the 15% rate, and then our last calculation will involve the 25% rate. But we're going to have to layer their income based on how this tax table tells us to break down the income up to the 25% rate and $139,350. So let's start with the 10% calculation. We'll look at that first. So I'm going to go through their column, married filing jointly. The 10% rate only applies to the first $18,550. So I'm going to take $18,550 and I'm going to multiply it by 10%. Now, what did I do here? That's not 10%. What I did here is I converted that percent to a decimal. So anytime you're going to use a percentage in a calculation, you have to convert it to a decimal first. So here's the easiest way to do that, no guessing involved. Percent, when we use the word percent actually means divide by 100. So if we're talking about 10%, we would take 10 and divide it by 100, and that's going to give us the decimal version of that percentage. This is the version of the percentage we have to use when we're actually going to use the percentage in an algebraic context. So rather than using 10%, we're going to use 0.1 instead. Same thing for all of our percentages. Anytime you see one, take it and divide it by 100, and that's going to give you the version of the percent that you'll use for your calculation. Now, anytime we're going to take a percent of a number, the word of in algebra means multiply. So 10% of this particular amount of income says take that amount of income and multiply it by 10%. So let's see what this looks like in the calculator. So we have 18,550 times 0.1, and that's going to be 1,855. So what that represents is the amount of tax owed on this particular portion of these people's income. This is not all of their income. That's only $18,550 out of the total of about $140,000. But this is the amount of tax paid for this part of their income. Okay, so once we've done that calculation, then we go to the next layer. We go to the 15% rate. Well, 15% applies for the next layer of income up to $75,300. Now here's another easy spot to make a mistake. We're not applying the tax rate to $75,300. Why is that? Well, we've already taxed the first $18,550. So what we want to tax at 15% is how much income is between $18,550, what we already taxed, and $75,300. We want to determine what's the untaxed amount based on where this range ends and what we've already taxed. So in order to determine that, I'm going to have to do a subtraction. So the upper limit for this particular range, $75,300, is where the 15% rate cuts off. But I don't want to tax the full $75,300 because some of that was already taxed. So I'm going to take the amount that I already taxed and I'm going to subtract it from that $75,300. And that's going to give me, in this case, $56,750. That is the amount of income that's taxed at the 15% rate. So it's the total amount of $75,300 that rate applies to, other than the amount that was already taxed, which was the $18,550. So that's where that comes from. So this is going to be the portion of their income that's then taxed at 15%. So I'm going to take that amount and I'm going to multiply it by 15%. And again, remember, percent just means divide by 100. So 15 divided by 100 comes out to 0.15. So that's going to be the decimal version of the 15% rate. So it's 15% of that income. So I'm going to take 15%, or 0.15, and multiply it by the income of $56,750. And that gives me $8,512.50. So keep in mind, we are talking dollars. So as opposed to 0.5, think 50 cents. Okay, so that's going to be the additional amount of tax that's applied to all of the income up to $75,300. So the first $18,550, this was the tax on that. The additional income they made up to $75,300, it was a total of this much, resulted in tax of $8,512.50. Okay, now where are we so far? Well, we've only gotten up to $75,300 of their income, but we know they have about $140,000. So now we're going to go from the 15% rate to the 25% rate. So 25% applies all the way up to $151,900. Well, they didn't make that much money, but the money they made does fall within the range from $75,301 to $151,900. So the next layer I want to create for tax purposes is going to be all of the income left to get us up to their total, except the amount that was already taxed. So what was already taxed? Well, up to $75,300 was already taxed. So I want to take the total amount and I want to subtract what was already taxed, which was $75,300. I want to subtract that because I don't want to double tax it. If I apply the tax rate to all of this, then I'm double taxing those amounts that we already had the tax rate applied to. So for my 25% calculation, I'm into my bracket, into the 25% bracket. I'm going to take that total amount, which is where our calculation ends, and I'm going to subtract that amount that was already taxed, which was a total of $75,300. It was layered into a 15% calculation and a 10% calculation, but a total of $75,300 has been taxed. So I'm going to subtract those two numbers, and that comes out to $64,050. Okay, so that is the last layer of their income. What you'll notice is if you take this number, if you take the $18,550 and then the $56,750 and the $64,050 and add all of those up, they will add up to $139,350. So those are the three layers of the income. That's how we've broken down the income in order to apply the three tax rates that apply to these taxpayers. So I'm going to apply the 25% rate to my last range of income. So $64,050, I'm applying a 25% rate, so times 0.25. Remember, you cannot multiply it by 25. You multiply it by the decimal version of 25%, and that's going to give us $16,012.50. So that's going to be my last amount of tax. That's the amount of tax applied to that particular range of income. So notice the amounts of tax go up, but particularly from 15% to 25%, notice the amount of income that was taxed didn't really go up that much. It went up by less than $10,000, yet the amount of tax was almost doubled. That's because the tax rate was higher. So even though we were taxing close to the same amount of income, because we're applying a higher rate, the amount of tax goes up significantly. So each of the values we get once we multiply by a tax rate is considered portion of the tax bill. So our actual tax owed is just going to be the sum of all three of those individual taxed amounts. So we take that sum, and then that is going to be the actual tax owed. So let's verify that in the calculator. So 1,855 plus 85,1250 plus 16,012.50, and sure enough, that comes out to $26,380. What does this represent? This is the amount of income tax due for this particular income if it's based on taxpayers who are married filing jointly. Now we're almost done. That's not the whole story though, because these people have a tax credit of $7,500. That's subtracted at the very end. So once we calculate the tax they would normally owe on this much income, then we apply the tax credit, and that's the last value that we subtract. So minus their $7,500 tax credit takes us to $18,880. That's going to be the bottom line. That's what they're going to officially owe for the year. So again, potentially they've paid most, if not all of that, through withholding. If they paid more than that, say they paid a total of $20,000, well, the excess would then be returned to them via a refund. Or say they only paid maybe $17,000, something like that. They didn't have enough withheld. The rest of it they would then owe to the IRS, and they would send that payment with their tax return. So that's what the tax calculation is going to look like. There's a lot of layers. We have to calculate values involving income, and then we have to use the tax table. So yes, there are a lot of layers. I want to do one more example where we put it all together. So all the way from the very beginning down to the bottom line, what does the full calculation look like? Okay, so we want to calculate the income tax owed by this person described below. So this person is a single woman with one dependent. She has gross income of $62,000. she has a $4,000 adjustment based on payment to a tax-deferred IRA. IRA stands for Independent Retirement Account, or Individual Retirement Account, excuse me. And then deductions, she has $7,500 in mortgage interest, $2,200 in property taxes, $2,400 in charitable contributions. And then she also has a tax credit of $500. Okay. So what do we know at this point? Well, we know her filing status. It says this person is single. So what that tells us is that we're going to use the single column in our tax table. Okay. This person has one dependent. Now what that tells us about is the exemptions. It tells us, no, we don't have one exemption, but we have the one for the person themselves. We have the personal exemption, and we have an additional exemption for this dependent. So we'll have a total of 2 exemptions for this particular taxpayer. Then we have their income, we have adjustments, we have all the different deduction amounts, and then we have a tax credit. Now the one thing we're missing here is the standard deduction. That is also something included on the tax table though. So if you look at the very bottom rows on the tax table, we have the standard deduction amount, and then we have the exemption amount. So the standard deduction for a single person here is defined as $6,300, and the individual exemption amount is $4,050. So the possible exemption she could take would either be, the possible deduction she could take would either be $6,300 or the sum of her standardized deductions. And then the exemption amount, she gets one exemption for herself and then one additional exemption for her one dependent. So that $4,050 is going to be subtracted 2 times. Let's start at the beginning though. So first thing we need is AGI. We need adjusted gross income. Well, this person has income of $62,000, and we know there's a $4,000 adjustment. So we're going to take the income, subtract that adjustment, and we have a total of $58,000. That's going to be the adjusted gross income. Now again, keep in mind, if there were no adjustments, then gross income and adjusted gross income are going to be the same. If no adjustments apply, it's essentially the same thing as subtracting 0 there, which wouldn't change anything. Now from that, we want to build and get the taxable income. So we know there are going to be 2 exemptions. Each of those represents $4,050 deducted from our adjusted gross income. And then we need to determine what to do with the deductions. We can take a standard deduction of $6,300. So remember, that was determined by the government. Single person standard deduction is $6,300. So she could deduct $6,300, or we can look at her possible itemized deductions and see what those total up to. So $7,500 in mortgage interest, $2,200 in property taxes, and $2,400 in charitable contributions. We add those up, and those total up to $12,100. So in this case, comparing the 2, the itemized deductions are going to be worth more. So she's going to want to use the itemized deductions instead of the standard deduction. Again, do not make the mistake of taking and subtracting both of those amounts. The standard deduction no longer applies because we're going to use the itemized deduction instead. So you're never going to subtract both of them. You always subtract whichever number is going to be higher. So we're going to take our adjusted gross income, subtract our itemized deductions, and then the personal exemption, and then the exemption for her one dependent. So our taxable income is then going to be $37,800. So again, for the government's purposes, she made a total of $62,000, but this is the only portion of that income that they're actually taxing, that she's actually going to have to pay taxes on. Okay, so that is going to tell us what her tax bracket is. It's going to tell us how we're going to layer her taxes. So she is single, so we're looking at the single rates. So the rates are 10, 15, 25, all the way up to 39.6. She made a total of $37,800 for tax purposes. And so that takes her into the 25% bracket. So the 25% bracket starts at $37,651, and she made $37,800. So she's right there on the threshold, but she does make it just barely into the 25% bracket. So that means we're going to apply the 10% rate to some of her income, the 15% to some of it, and then the 25% to whatever's left over at the very end. Okay, so she has a 25% bracket. We're going to start with the 10% calculation. So let's look at that. So for a single person, the first $9,275 of their income are taxed at the 10% rate. So $9,275 times 0.1, so times the decimal version of 10%, is going to come out to $927.50. Make sure you can verify that with a calculator. Okay, so she has a total of $37,800 of income. We've now taxed this portion of the income. So then we're going to go to the 15% portion, and we want to tax the next layer of her income. So all the way from $92,755 up to $37,650. So we want to take the total amount that's taxed at the 15% rate, but subtract whatever we've already taxed. So we already taxed $9,275 worth of income. So we're going to take the upper limit of that particular range and then subtract the amount that was already taxed. So $37,650 minus $92,755 comes out to $28,375. So that's going to be the portion of her income taxed at the 15% rate. So $28,375 times 15%, or 0.15, is going to be $4,256.25. So that's going to be the additional amount of tax she's going to owe on this particular layer of her income, on the second level of her income. Now we're not quite there. So we taxed $9,275. Then we taxed everything up to $37,650, which ended up being this much additional income. But we're not quite to the $37,800. So anything that's left over, which again now takes us into the 25% range, we now have to tax. So we've taxed a total of $37,650 so far. We need to get all the way up to $37,800. So we're going to take the total amount we have to tax minus everything that's already been taxed, and that leaves us with $150 left. Now, how can you verify that you've layered this in a meaningful way? Well, look at all the different amounts that were taxed. So this amount was taxed, this amount was taxed, and now we're saying $150 has to be taxed. What happens if we add those up? So $92,755 plus $28,375 plus this additional $150. Look what that adds up to. Not a coincidence that adds up to $37,800. Again, the idea is we're taking this amount of income and we're layering it into different levels based on which portions are associated with which particular tax rates. So that at least tells us that our layering makes sense. So that last $150, we're taxing at the 25% rate for a total of $37.50 in tax. So I'm going to take each of my tax amounts and I'm going to add all of those up. So $927.50, $4,256.25, and then $37.50 for that last little bit of income. That's going to add up to $5,221.25. So again, for all intents and purposes, that's her bill, but very bottom line, we do have a tax credit of $500. So that is then credited, which means subtracted from her actual tax. So we're going to take the bill based on the tax computation and then subtract the value for that credit. And so her very bottom line is going to be $4,721.25. And again, in theory, most of that has been paid through her employer, if not all of it. If she's paid too much, she'll get a refund. If she hasn't paid enough, then she will have to write a check to the IRS and pay the rest of it. So that gives you a sense of a little bit of what the income tax computation looks like We know how to calculate taxable income, and from that we can calculate a tax bill. Again, keep in mind taxation is a very complicated topic. There are so many specific situations that apply to different people. So if there's ever a question about whether something applies to you or how you handle a particular situation, that's always a good time to consult a tax professional. At this point though, you should have a good sense of in general how these kind of things are calculated, and if you're in a simple tax situation, you can calculate your taxes yourself.